Welcome to the Capital Alliance Advisors presentation on the 3 deed of trust investment options that provide very high yield fixed income. Russell Rosner, and if at the end of the presentation you have any questions whatsoever, give me a call at 415-288-9575, or you email me at the email address that's presented to you right here on the slide. So without further ado, let's begin. With what is a real estate deed of trust? What's an L for bridge and private loans? Properly structured deeds of trust actually about? What are deed of trust investment options? And what are mortgage bonds and debenture enhancements? We'll get later. Trust defined. A deed of trust is a written document legally conveying real estate to a trustee to secure a promissory note. The trust is recorded in the county where the real estate is located. Investing in a deed of trust is simply just making a loan to a borrower, and your loan is secured by their real estate. Typically, these loans are made by banks, but sometimes they're made by individual investors, retirement plans, and other entities, such as pension plans. A proper deed of trust is suitable for investment accounts, including IRAs, and they normally generate monthly income in excess of 5.5% to about 11% annually. They have multiple characteristics which create safety of the principal or the loan amount. These types of loans are often referred to as bridge, private, or hard money loans. So why would a borrower pay up to 11% interest when the interest rates are at an all-time low? Well, the rationale for a bridge or private loan. One, a bank will not do a loan for 2 reasons. Either the borrower doesn't qualify or the property does not qualify. With that in mind, let's go over the list. To start with, often a property can't qualify because of its condition, or a borrower might own 10 or more properties. That's exactly right. What we mean by that is that a borrower has 10 or more loans. The federal government will not make more than 10 loans to any one individual. Or can't wait 45 to 60 days for bank approval. It takes time to get a loan from a bank. The borrower wants to borrow through a business entity such as an LLC, a trust, a corporation. That has had a strategic default that affects their credit. Many people in the late 2000s or 2010s did walk away from their homes because their home was upside down, and they made a strategic decision to walk away from the property. Finally, the borrower is self-employed and has fluctuating income. So, are private bridge loans safe? Well, there's a common misconception that all loans using bridge or private financing are risky. A properly structured deed of trust doesn't have to be risky. And as we've explained, there are many legitimate reasons why borrowers might use bridge or private financing instead of bank money. Let's give you an example. Before we use the example, I just want to mention one more thing. The properly structured deed of trust can create safety of principal through mostly a loan to value. The low loan to value means a high equity buffer. So taking this example, at 7% loan to value, a borrower or some lender has a 30% equity buffer in the property, and the property would have to drop 30% in value before there was any loss of principal. So lower the loan to value, the safer the loan, and the safer the investment. Structured deeds of trust create safety of principal. Values are placed on today's current market environment. There's no need for an appreciation to achieve investment returns. I see the California median home prices at an all-time high of $484,000 back in 2007. They dropped precipitously, and now they're creeping up slowly. Structured deeds of trust create safety of principal by loans being secured by income-producing properties. The loan amount is typically at or below the property's replacement cost. Each loan must have a definitive exit strategy, or property sale, or refinance. Or loans are secured in a first lien position. It's safer to be in first position than to be in second position. loans have maturities of less than 5 years. If a loan has a maturity of longer than 5 years, then we don't know what the market's going to be like after that period of time. So the shorter the maturity, the more likely we'll know what the market's going to be doing and have a better understanding of what the market's going to look like, and this can make intelligent decisions about who we lend to and what we lend on. Both experience and ability to pay must be carefully evaluated. The originator of a loan has specific geographic focus. Often, lenders that are involved in deed of trust investing only loan in their local areas. So they don't loan nationwide. They might loan within a 100 or 200 mile radius of their offices because it's the area that they understand. They understand their own backyard. Loans are professionally serviced and more conservative underwriting guidelines when compared to most banks. What I mean by that is that private money loans are underwritten with even more scrutiny in most cases than a bank would underwrite a loan for themselves. Like comparison between a bridge and a bank. To start with, a private loan has a high interest rate. Banks are low. The closing time is 7 to 21 days for a bridge loan, but a bank takes a very long time, up to 2 months or more. With bridge lenders, borrowers can borrow on investment property. Banks, although they do investment properties, are more focused on owner-occupied properties. The condition of the property may be in need of renovation, but the banks will not do a loan on a property that is in need of renovation. For instance, it needs work on the roof or needs a new foundation. Many reasons why people buy properties for investment purposes. Loan maturity is 12 to 36 months, and obviously banks will loan up to 45 years. The borrower's credit is evaluated on a case-by-case basis, where a bank is locked into a FICO score. In other words, if a borrower has a FICO score below a certain threshold, they will never qualify for a loan. And finally, bridge and private lenders can make loans to all types of borrowers, whereas a bank or institution typically only makes loans to individual people. So what are deed of trust investment options? Well, there's individual deeds of trust, which is simply doing a mortgage loan to one borrower with one property. Mortgage pools, which is a group of individual trust deeds, mortgage loans held by a company, and there are mortgage bonds or debentures. A bond is something that is secured by mortgage loans and the company's equity. It is issued by the company and is senior to the company's equity and other unsecured debts. We'll get a little bit more on that later. So let's compare individual deeds of trust with mortgage pools. Return is high, 8-7%, as opposed to 5.75 to 8%. That's because there's not as much diversification. You'll get a higher yield for more risk. And if you're making one loan to one borrower on one property and something should go wrong, you're not going to be able to make any, you're not going to be able to receive any payments. But if you are in a mortgage pool, that investment is diversified. There are loans on many properties with many borrowers. And finally, the payments are continuous on a mortgage pool, whereas in an individual deed of trust, if the borrower stops making payments, then the investor doesn't receive any payments until the borrower starts paying again. Investment for individual deeds of trust is often high, $100,000 plus, especially in the area that we're involved in, which is California. The minimum investment for a mortgage pool is $25,000. Liquidity after 12 to 36 months, whereas with a mortgage pool, it is a long-term investment, typically 5 years or more. The individual deed of trust will prepare a 1099 for a borrower, where with a mortgage pool, you have a K-1. And finally, individual deeds of trust are not leveraged or borrowed upon, whereas often mortgage pools are leveraged and borrowed upon. Deed of investment options. In a mortgage pool versus a mortgage bond, the return of a mortgage pool is 5 3/4 to 8%. The return of a bond is the same. They're both diversified. The minimum investment is pretty much the same. However, the differences are that a mortgage pool has a K1 tax reporting. One thing to mention is that a K1 does take quite a long time to be issued, typically until March. For those people that want to get a tax refund early in January, they're going to be able to because of the K1 reporting and 1099 reporting for the mortgage bond. Mortgage pool may be leveraged, whereas a mortgage bond cannot be leveraged. Keep in mind that if you have a mortgage pool, let's say $1 million mortgage pool, and you leverage it by 2 times, now you have $3 million. Should anything go wrong, you're increasing the risk for the mortgage pool to lose its principal. You're liquid after 5 years, and typically on a mortgage bond, you're after 5 or 3 years. Bonds can be over-collateralized. We'll get to that later. Deed of trust and notes are held by third-party custodians and senior secured position, and they are preferred. They're a preferred investment with a company. Talk about over-collateralization. At all times, the total unpaid principal balance of deeds of trust securing bond have to be 10% greater than the total bonds outstanding. So for every $100,000 that's invested in a mortgage pool that is enhanced by bonds, there's $110,000 worth of collateral. In doing so and having that structure, actually lowers the weighted average loan value. And the market value of a property is typically similar, and the effective LTV is effectively lowered as well because of the extra leverage. On debentures and enhancements. The third custodian holds the deeds of trust, so that actually does help in regard to security because the company that is making the loans doesn't have access to those loans, but the third-party custodian does. Finally, a senior secured and preferred. A bond is designed so the bondholders get paid before the subordinated debt or the equity holders of the issuer. They would senior and preferred position. In addition to the deeds of trust held by the custodian, the bonds are also backed by the creditworthiness of the issuer. Up to 8% annual interest rate with income paid monthly. Holders can have a senior, secured, and preferred position. Bonds can be over-collateralized. Various maturities can provide liquidity, not dependent upon property sales or finance, and they do 1099 reporting. In the varying maturities, you're able to invest in a 5-year bond, and a 3-year bond, and a 1-year bond, and you can stack them and create your own liquidity events on your own. So a little bit more wiggle room in regard to your planning for liquidity with a bond enhancement. Investing in real estate loans within your IRA can be a higher yield investment alternative to income such as CDs or money market accounts. You have to just invest with your IRA. You could invest directly with any form of funds you wish. There will always be a need for private loans, as the banks often disqualify loan applications. Structured deeds of trust provide high income and preservation of capital, and there are 3 types of investment vehicles. We have these investment vehicles as deeds of trust, mortgage pools, and mortgage pools with enhancements. If you would like to discuss which might be right for you, we're happy to help. As our company was established in 1991, funded over $1.5 billion in residential loans. We've hired over $500 million in investment property, and we've advised 7 publicly held REITs. So thank you for listening to our presentation. And should you have any questions, don't hesitate to call me, Russell Rosner, at 415-288-9575, or send me an email at rrosner@cls.com.